Can you see this now?
Yes,
Yes.
sir.
Okay, good. So basically, our investments, they energize. We say, you're going to energize your investments and maximize your tax deductions. One thing about oil is that it is a world market now, as far as the demand. So it's not just the United States. Oh, it is worldwide, and so this is kind of uh, some facts as far as what the demand is going to be projected to be into 2050. Right now in 2022, as you see, 8 billion people in the first half of 22. By 2037, they're estimating there's going to be 9 billion, and then 10 billion in 2060. And so right now we're using 102 million barrels of oil per day worldwide. It's estimated it'll go to 109 in 2027, 111 in 2028, 118 by 2045, and then 120 million by 2050. And it's going to take about a $14 trillion of oil investments is needed, by 2045. So, you hear a lot about, the, electric, cars and things like that. What a lot of people don't understand is oil's in a lot of products, not just gasoline.
Yeah.
And so the demand for oil and gas is going to be ongoing, not going to go down. It's going to be ongoing for quite a few years, and that's due to the more people that we have and the more cars and things like that. So, we have two investment products. I know you said earlier we want to talk about the mineral fund, but we have a drilling and income fund, and this is where we put together uh, multiple wells to spread the investors' diversification over a large group of wells, anywhere between 30 to 60 wells in a partnership. They're all horizontal wells. And so the difference, there's two types of wells drilled in the United States: vertical wells and horizontal. And the vertical wells is what has been drilled since the beginning of oil and gas exploration. But the downside to a vertical well is that you can drill a dry hole, meaning no oil and gas comes out. And in that particular well, you lose all your money. So that's been one of the big fears, and the big, kind of, voodoo for oil and gas is that people talk about, losing all their money in an investment, and that is the case in vertical wells. The horizontal wells kind of revolutionized oil and gas. They've been around for a long time, but the advent of the fracking technology, really, came into the focus in 2008. And with horizontal wells, I'll show you kind of an example here in a second, but you don't drill dry holes. Every well will produce oil and gas. So that takes that dry hole risk out of the investment. And that's a big factor. There's no guarantees on how much oil and gas a well is going to make, but they are going to produce some oil and gas, and in most cases, they'll produce a lot of oil and gas. So the first thing, what I like to, show here is that when people invest in an oil and gas program, a lot of people don't understand, the profits to the investors and the profit to the oil and gas company. What's been a standard in the industry for many, many years is what's called a third for a quarter. And what that simply means is that the investors get 75% of the deal and the oil and gas company gets 25% as a carried working interest. Okay. And most oil and gas companies only invest, 1% to actually perpetuate the joint venture. So they don't have a lot of capital invested into, their partnerships. Now, what we do for our investors is that we, give them 90% and REI gets 10, which is a much, much better deal for the investors. and we purchase a minimum of 3% of the units, in the every program, sometimes up to 5 to 10%. So we have, what a lot of people refer to as we have skin in the game. We invest right alongside the investors. Okay, and our programs, generate monthly cash flow. Another thing that oil and gas companies do, and they have what's called subsequent operations or subsequent cash calls,
Mm-hmm.
where they can go in and they can ask for additional cash from the investors over and above their original investment. And sometimes it is legitimate, but the majority of the times, what we have seen is that it's just been another way for these oil and gas companies to actually get more money from their investors. And so we don't have any subsequent cash calls. It's a one-time investment. Unit sizes are 100,000. The minimum is 25. We have an exit strategy in 5 years. So we look to cash flow the programs for 3 to 5 years, and then we look at selling it at the end of the fifth year for an overall return. And the investors get 90% of the cash flow that the wells are generating, and they get 90% of the sales proceeds.
So Paul, can I just ask, just so to clarify, because I know we talked about it, but just to be clear. So when people invest in this, they become a partner in this fund. Is that correct?
Correct.
Okay. And so they'll get a K-1? Is that how the income is reported?
Yes.
Okay. And I know we talked about it. This isn't like a buying and selling strategy. This is you're in it, and like to the exit strategy is 5 years. People who are looking to invest in this should just plan on having their investment in this for 5 years. They really can't say, "Hey, I want to get out now."
Yeah, that's correct. It's non-liquid investment.
Right.
That's the way all limited partnerships, as far as oil and gas goes, there's not a market for selling the oil and gas, wells like there is a stock. I mean, if you bought a stock today, you could sell it tomorrow.
Right.
With oil and gas, properties, you sell them two ways: either privately negotiated sales with other companies, or in auctions. They have 4 or 5 large oil and gas auctions every year. And so that's, we have bought a lot and we've sold a lot. And so that's what we'll do. But because there is no market, there's no guarantee that you're going to sell it in, any year that you start or want to sell it.
Right.
But it is an illiquid investment.
Okay. I just wanted to make sure that people listening understand that it's kind of, you're kind of in it for a little bit.
You're in it for the entire time once you make the investment, because your investment is into the wells. And that's the other benefit of with the horizontal wells, whereas the vertical wells, you're in that the same way. But if they drill a dry hole, you've basically lost all your money. You're not going to get anything out of it. So you're done at that point in time with that investment. Here, you're going to at least, see cash flow. And you're going to see, there's no guarantees on how much, but you are going to see cash flow. So that risk tolerance is, a lot of difference, a big difference in the horizontal wells. And then as far as, when you come in, like you said, you are, a partner, you get to elect whether you want to come in as a general partner or as a limited partner. It is a limited partnership overall, but you have a choice to come in depending on how you want to take advantage of the tax benefits. As a GP, general partner, you can use it against all income derived in the years the wells are drilled and completed. And that's a key word here. It's in the year the wells are drilled and completed. So, you can write off up to 80% of the investment in the year the wells are drilled and completed. And on a multiple well program, not all the wells are going to get drilled in 1 year. So you're going to have, some wells get drilled this year and some get drilled next year. And so on our investments, you're going to get about anywhere between 35 to 45%, this year, and then you'll get 35 to 40% next year.
And Paul, so for those people who invested in your Fund 7 in 2024, and on a assumed $100,000 investment, you'll eventually tell us, as probably you said, there's a period of time into the current year where that count still is credited to prior year in terms of getting to that right percentage for 2024. In other words, the accounting is still happening for 2024, correct?
Well, yeah, it's yes and no. What
Okay.
you're referring to is that the IRS, in order to get the write-offs for this year, you can prepay the intangible drilling costs at the end of last year, which we did on the wells. And
Yep.
then you have to the March 31st of this year for that well to be drilled so
Gotcha.
that you can take the tax benefits for last year on
Gotcha.
those wells that you're able to prepay.
Okay.
So on the 20 on REI 7, the we're projecting that the write-offs are going to be somewhere between 35 to 40%, on that program for 2024, and then
then
the
the balance.
remaining of it will be on this year.
Gotcha. Okay.
So, and then if they choose as a GP, just to be as transparent, you do have more liability risk as a GP than you do as an LP. Okay. Now, one of the things that we do to mitigate that liability risk is that we carry a $25 million insurance policy that covers the entire joint venture. And that's more than enough to cover our interest in the wells. But in addition to that, you have an operator of the wells, and the operators in these, every well has an operator. The operators are major oil companies, major independents, so they carry large amounts of insurance. And then you have a drilling company and a fracking company, and they're independent of the operator. So you have actually three shields in front of our uh, insurance policy. So the likelihood of investors seeing any kind of issue with the liability claim is very, very remote. We have participated in over 3,000 wells, both onshore, offshore Gulf of Mexico, since 1987. We have never had a liability claim ever make it to the investors. So while the risk is there, it's very, very minimal. As a LP investor, they can only write it off against passive income only. And their investment is limited to the size of their investment. So if they're invested 100,000, that's all. If they were ever to get to a liability issue, that's all that an LP could be liable for. And our programs are for accredited investors. You can see with the vertical wells here, here, and here. So, with a vertical well, you only see about 5 or 10 feet, outside of the well bore. So you could actually drill right here, and it'd be a good well. And had you drilled over here, it could be a bad well or a dry hole. Same way here. And then you can see this is a dry hole. It was not drilled into the formation. It was drilled into the into the rock that it was not productive. So, and the difference with a horizontal well is that you have typically a 10,000 foot vertical leg, and then you have a 10,000 foot horizontal leg. And so the oiling, the horizontal wells, they go all the way through the productive zone there. And then they open it up with the fracking. They'll perforate it about every 200 feet back up that 10,000 foot leg. And you've got openings there, and they frack all the way through the formation. So you'll have anywhere between 60 to 90 stages on that 10,000 foot leg. So each one of those stages has perforations in it, and that's where they frack through. And what a frack is that a lot of people are under the misconception that oil's in a pool under the ground and you just stick a straw in it and suck it out. It's not the case. It comes through the rock. So in order for it to come through the rock, you've got to have a number of things present, but the main two things is porosity, which is a hole in the rock, and permeability, which is how well those holes are connected. A good layman's term example, brand new water hose. Hook it up to your faucet, turn it on, you get a lot of pressure out the end of it. That's an example of good porosity, good permeability. You take that same water hose, cut a bunch of slits in it, you're going to get a little out the end, but the majority is going to go out the slits. So that's an example of good porosity, bad permeability. The type of source rock that horizontal wells produce out of is shale. And shale has porosity, but it has very little permeability. And so what a frac job does is they go in with sand, chemicals, and water under extreme pressure, and it fractures that rock. And the chemicals have propping agents in there that prop open the rock and artificially create that permeability. So that's what a frac job does. So when you open up that entire formation, that's why you're going to have every one of these horizontal wells are going to produce. And here's another example of the fractures that that we were talking about. And then you also, in horizontal plays, you'll have multiple pay zones. So like you have one here for the Cherokee Shell, and then one down here for the Red Fork, the Skinner, and the Prue. And so each one of those you'd be drilling a well to, produce oil and gas. And so because these wells only drain a certain amount of acreage, these wells are put on what's called 1,280 acre production units. And a 1,280 acre production unit, to drain it, you're going to need anywhere between 2 to 6 wells to drain that 1,280 acres. And that's to each one of these pay zones you see here. So in essence, if you've got 4 pay zones right here and you drill the maximum of 6 wells, you could have 24 wells that are permitted in your 1,280 acre block. So you can see how that could definitely, be advantageous to, to production, advantageous to the, revenue that you're going to receive from those wells, over the years. And then also, if you're not going to drill all of them in the 5 years that we anticipate holding this, all of these additional locations that you don't drill are called upside potential. And so when you sell an oil and gas well, you're going to sell basically all 40 months of current cash flow, and then you're also going to get value for these upside locations. So that's that can benefit you when you're getting ready to sell the program. Yeah, right. Let me show you right here. So
then it begs the question: why would you sell?
Why?
Yeah.
Well, the thing about it is that most investors don't want to be in something forever. Okay?
Right.
So you want to have an exit strategy out of it. And there's kind of a sweet spot in the oil and gas, horizontal wells. They're typically going to produce about 40 to 50% of the total amount of oil that they're going to produce over their lifetime in that first 4 to 5 years.
Okay.
So when you sell it, like I said, you want to be selling it on cash flow. And so the cash flow is going to be, kind of at the peak level at that time. And that's when, the best time to try to sell it.
Right.
Now, I mean, yes, you could keep it. And, again, there's no guarantees, that you can sell it, but that's kind of, the sweet spot, what you're looking for to sell.
Right. It's almost like laddering your portfolio. So you have a time to exit strategy. Yeah. Okay. I got it.
And so, just to show you, each one of these these 2 blocks here, are you seeing this?
Yes.
Cursor? These are 640 acres. So 2 of them is 1,280. So that makes the production unit. And so the easiest one to see right here is this right here. You can see these dotted lines.
Yeah.
So that particular 1,280 acre has 3 wells that are permitted to be drilled in there. Okay. So far. All right. That's what I was talking about, is that, we're going to drill maybe the first one and the second one, or we'll participate on, the drilling the first and the second. And then that third one will be, what we would be selling as upside.
Okay.
In the same way, if there'll be, additional wells, before you drill a well, you have to permit it. Okay. And in Oklahoma, the permitting process takes a little bit longer because they do some different things in other states. It's called force pooling, things like that, which I'm not going to get into. The advantageous for these operators are to go in and to permit 3, 4, 5, 6 locations at a time. And so that way, when they get ready to drill it, they don't have to go wait and, wait through the permitting process. So, and these are just to the Cherokee Shale. Like I said, there's deeper formations in this that we showed earlier. So these are just to the Cherokee Shale, formation on it. So that's kind of what we're doing. But all of these areas here that you see, these yellow, these are all wells that we are participating in.
Are all your wells in Oklahoma?
Yes, all these wells are in Oklahoma. That's in REI 7, and REI 7 has one in North Dakota and a few in Texas. But these are all, the majority of these are in Oklahoma. But we focus in Oklahoma and also in the Bakken in North Dakota. So we could have wells in both. And also, there's some exciting, really horizontal plays going on in Texas now too, close on the Texas-Louisiana border. So we're participating in some of those. So, but our two main focuses is northwestern Oklahoma and North Dakota, the Bakken. So as far as talking about, a program, I'm going to show you the K1s, some things like that for this Drilling Fund 1. This program has been online since July 2020, right in the middle of COVID. In fact, the first distribution was July of 2020, and we actually got right at $18 a barrel for oil in that particular month. It averaged over the first 12 months, $42.62 a barrel. And we still generated over $26,000 worth of cash flow to the investors based on a $100,000 investment. So it shows that our programs can perform well in low price environments. So this is the K1 that investors get. This is the next ones I'll show you will be kind of just a blow up of the where the deductions are. But just to show you here, I didn't highlight this up here, but this is like the ordinary business income. As you can see, in this first year, it was a negative. That's when they were just in the start of, drilling wells. The, deductions for that year, the total of 20,807. That's 16,728, which is the intangible drilling cost, plus the 4,079 is 2807. So you can see it right here. So these are the three numbers that you will see on a K1 that we send out. And we do this for, every partnership, and they go out typically in February and March. So this is kind of a blown up of what we just showed there. In 2020, you can see with more wells being drilled in 2020. So back to that example I was giving you, that have some wells drilled in the first year and some drilled in the second. This case, they had the majority of the wells drilled in the second year. Then in the third year, they actually had a little bit of drilling going on into the third year on this. Now, typically our programs, we anticipate to have all the wells drilled in 2 years, but in some cases it could take a little bit longer. We're not in charge of when the wells get drilled. We own non-operating interests, so the operators are in charge of when the wells get drilled.
And Paul, just to be clear, so in box 19, the distributions, that's the cash flow to the investor, right?
Well, 2019, there wasn't any cash flow.
No, not that year. So go to the next year, 2020. So yeah, the distributions, is that the cash flow to the investor?
Yes.
Okay.
And here, in 2022, 2023. So here's the chart that basically shows you kind of what happened for REI 1. So the first column there's intangible drilling costs. As you can see, it was 20,807 in 2019, 45,293, and 5,038. So that was a total of $71,138. So the intangible drilling costs by themselves were 71%. And you add in the cost basis depletion for the lease costs, which is an additional $8,475. So when you add both of those together, you can see down at the bottom here is $79,613 as far as the total write-off. So that's when I say up to 80%, you can see that's right there, 79.61% for that particular program. And so investors on this program were able to take those write-offs over those 3 years. The majority of it in the first and the second year. And then the excess of basis depletion, that's a key number because when you sell a program, you are going to have recapture. But anything in excess of the basis depletion, which is on this, which is 17,092, you look down here at the bottom, that represents 22.3% of this $76,744 that they received. And that is the income that's received as tax-free for the life of the program. It's not subject to recapture. So on this program, they've gotten $17,000 as of 2023 that is tax-free. There's no other investment on the market that does that. Plus, the big write-offs up front. So that's kind of the chart of what REI 1 has done and how it breaks down as far as the tax benefits. Now, the way you calculate what the tax benefits mean to an investor is you take the investment size times 79.61% times their marginal tax rate. In this case, this gentleman was 37.5%. So he actually saved $29,853.75 in estimated tax savings. So the way that it works, in terms that, another way to look at it is that reduces your adjusted gross income. So you have a $300,000 adjusted gross income, you're in a 30% tax bracket, you owe $90,000 in income tax. You have a $79,000, $80,000 write-off, that reduces it to $220,000. So in that same example, 30%, now they save, right at $66,000 in taxes that they would have owed. The after-tax value, investors are always asking, when will I get my money back? Well, in this investment here, this is, shows you on cash and also the estimated tax savings. So $100,000 investment, the program distributed through 26 months, $70,842. When you add the estimated tax savings of $29,853, their total after-tax value through 26 months was $100,695. Now, the estimated tax savings is after-tax value. Even though you could look at it as a return of your capital, because without making this investment, you would never have been able to get that type of write-off. Right. So you can, that's why we put it in here like this. But cash on cash, they got 70,000. Estimated tax savings 29, for total 100,695. Going forward through 2024, through December of 2024, the program distributed $94,969 with the tax savings. Through 55 months, they're at $124,822. And what we will be doing this year, the plans is to sell REI 1. And so when we sell it, then they would get the overall, they would get 9% of the proceeds, which would be the overall return. What we project on this particular program was about a 1.85 to 1 return. So on $100,000, they would have gotten back $185,000 total. And that would, give them an $85,000 profit is what this particular program. Every program is different. Our newer programs, we're projecting, 2 to 1 to, as much as a 2.5 to, in some cases, it could be, 3 to 1 potential. But that's kind of what we were projecting on this particular program. So in order for them to get to the 185, they need additional, basically $61,000 if you include the tax savings. Without it, about a $70,000, excuse me, $90,000 more. And that, is going to be from, when we sell it, and we anticipate being able to do that this year. And so here's, a list of all the funds that I have, what they've done. The Archer partnership at the top is the first one that we went through the whole course of selling it, cash flowing it, and selling it. As you can see up there, the investor capital is 1,394,210. The distributions and the sales proceeds, they got 2,603,473. That was over 72 months. The annual cash flow averaged 19.9%. So on a $100,000 investment, they got $19,900 a year in cash flow. That is included in the distributions and the sales proceeds. And then we sold it. The total return was a 1.87 to 1. So that is a program that went through the entire cycle.
So after 6 years, you almost double your money.
Yes. On that particular one.
On that particular one. Yeah.
And that was basically a small one, and as our funds have gotten larger than the capabilities, because you have more wells, you have more production, more cash flow, and so those programs hopefully have the potential to to do more. And I'll show you kind of what we're looking at on that in a second.
And quite frankly, after 6 years to almost double your money, that's pretty good, right?
Yeah, and like I said, I mean, that's a straight, that's not including the tax benefits. That's just cash on cash and the sell.
Okay.
When if you added in the tax benefit on that, which is, let's just say, another 30,000, then you're looking at 2.17 to 1. So that's two ways you can look at it, because the added value that you get from the tax benefits.
Right. Okay. Other than then you do get the stinger at the end of the recapture.
Yeah, that's what I was just saying. I'm like, until you sell, and then it's painful, right?
Well, yes, you do have recapture, but the way that the accounting on an oil and gas partnership is that it's not like it's not like recapture on a lot of things. I would have to have our accountant explain it a little bit better. But yes, you do have some recapture. Here's an example on 5. As you can see, the first 11 months, what the cash flows were. And then when we started getting, the revenue from the wells that we had larger ownership, you can start seeing the cash flow, go up. And so these 6 payments, the cash flow is average 16.676%. And so that is, the sign of the larger ownerships, but it also shows that the program is, on the right direction. It's continuing on, and as we get more wells online, that's one thing. Maybe step back. When a well goes online, you start accumulating revenue from day one, but you don't actually get paid for it, where it's called in pay status, for 4 to 5, in some cases 6 months after the well goes online. So while we have a lot of these wells that are online producing, we haven't got paid on them yet. Yeah. And so that's why you see, the cash flow is going up, because we're getting paid on a few, but as more come online, then it's going to, steadily increase. And that's what you see also on 6. So the first 3 months of 6 was interest only. We didn't have any wells in pay status. So those were interest only payments. And then in July, that was partial. And then we started getting wells in pay status. And so the cash flow started jumping up, and they've averaged over 33.3% over the last 6 months. Now, one thing you see in here, this 54, 56 for this 1 month. One of the things that operators do with the other working interest owners is that, like I said, you start accumulating revenue from day one, but you don't actually get paid on it in some cases to 4 to 6 months after they go online. But what they do is that they'll pay you for 4 months of production when they do pay you that first month, with the first time. And so that's what represented here. We had one well that we got paid 4 months of production on, and that's why it jumped up to that level for that particular month. And that occurs each and every time that you start getting that first distribution.
Do you expect the same kind of timeline for the Fund 7, that it looks like maybe it's not until the second half of the year that the real cash flow starts coming in?
Yeah. Yeah, the first, exactly what's happened on 7 is the first 2 distributions were interest only.
Yeah.
And, we have the Mallard well in 7 that has been online since May. And we have not gotten paid on it yet from Devon. Devon is a new, they're a large company. They just haven't paid the working interest owners yet. We're expecting they're going to get paid on it this month. And so it would go in with distributions next month. And then we have the second well that's in there that's online that we should be, getting close to. It went online, I think, about September, so October. So we'll, start seeing cash flow from it. We have right now 42 wells in 7. And of that, 2 of them are producing. 2 of them are, waiting to start producing. They've already, getting ready to be turned on. Then we have, 3 wells that have, drilling completed and they're waiting on completion. Then we have another 6 wells that are getting ready to be drilled in that program. So there's a lot of activity going on in 7 right now.
So, I don't remember if we talked about this. So the idea for an investor that they find interest in this, like right now, does it make sense for folks to, forego their $100,000 in February, or should they do something else with that money and come calling to you at the end of the year?
That's what a lot of people have waited around for a long time, and even accountants and RIA guys and other broker dealers and things like that. They always waited for the end of the year drilling. Well, the thing about it is that you can't guarantee how many wells are going to get drilled when you're at the end of the year. So while we don't have to come up with the capital until we get called for, meaning on AFEs. AFE is an authorization for expenditure. When an operator is getting ready to drill a well, they'll send out the AFEs to the other working interest owners, and that's your proportionate share of how much it costs. So we've got a well that's getting ready to start drilling in 8 right now. So, that enables us, investors who invest now, enables us to be able to take advantage of those locations, because if we don't have the capital, then we're not able to take advantage of those AFEs when they come in. So it's conducive for them because they're going to give the opportunity, to get in earlier. They're going to give the partnership an opportunity to take advantage of wells in the beginning of the year. And they're also going to get the tax benefits for the whole year.
And so investing today, you're suggesting that within a few months from now, there may be monthly cash flow other than interest earned on that investment.
Well, it will be accumulative. Once you have a well in the program producing,
Yeah.
the partnership is accumulating that revenue.
Yeah.
But to be fair to all investors in our programs, we don't distribute any of the capital until the program is closed. This program is going to, last year we kept it open, for the entire year because we have we had some, unique circumstances with, additional operators moving in. This program is going to probably be open till, end of April, May, something like that. And, then we'll have another partnership for for the next part of the year. But
Oh,
So it's capped out, the investments.
Yeah.
Okay.
well, no, it'll just be funded. I mean, these are $5 billion offerings. We have the right to increase them up to 20 million. So we'll raise the capital. What we're estimating is we raise the capital to the, let's say the end of May, and then we'll shut this program down and open up another one. And so there's no guarantees on what the next program will have. This one, you already have it. So that's why it's advantageous to, for the investors to get in on, as soon as possible on an investment.
And when you say they already have it, you already have all of the, like you've identified where all the wells are going to be. And so I kind of, like I said, when we talked before, it's like a mutual fund of oil wells.
oil wells. Yeah.
And it's not a mutual fund, but that's the way I think of it. It's kind of like diversified a little bit across all these different wells, a couple different companies. So you're saying you've already identified those wells for this fund, and then it will close out in like April or May, and then you start to build a new fund with different wells and different groups of companies, and not really knowing what those are just yet.
That's right. We have 400 and about 411 acres that we have the rights to the ownership of. Now, like I said, when they get ready to drill one of those locations, we have to come up with the capital for that.
Right.
So when those 411 acres are spread out over 29 different 1,280 acre units. Okay. So we might own 5 acres in one, we might own 100 acres in another, 20, 30 acres. And so we know that those, we're estimating that those are 40, right at 40 locations that we can drill on those different, 411 acres in those different, drilling units. And so, yes, that's how we know what we have with that right there.
So really, this is best for, you have to be an accredited investor. So there's a cash flow perspective to this, but there's also a large tax benefit for those indirect drilling costs.
And because it's ordinary, it's great for people with high W-2s. Paul, thank you so much for your time, and this is wonderful for me. I appreciate you going through this. And
I appreciate
Josh,
it.
now we'll coordinate another call on mineral rights. If we can do next week, Cheryl, is probably dependent upon how you and I are looking from a tax process perspective.
Well, the thing about the minerals,
we could take an hour to talk about it. I think that's, especially if it's important for our clients to be able to have access to something that can help them. I would like to get that, get something on the calendar so we can make sure people know about it. Because I don't understand the mineral rights. That piece, I'm still
Okay,
struggling on that one.
we'll do that. And Paul,
it's much shorter too. So,
okay. Well, very good. Thank you, everybody.
All right. Thank you.
all right. Thank y'all.